Pensions at retirement, that's the topic for today's video. But more specifically, if you're retiring with a defined benefit pension plan, there are 4 critical questions that you need to be aware of. So, Shaun, after dealing with hundreds of different client situations, ton of different scenarios that are very nuanced, what is the first key question that people retiring with this pension plan need to answer?
The first question is just be really, really clear on your formula. So defined benefit pension plans are often referred to as formula plans. And so on average, the formula sort of sounds or looks like this. Take your years of pensionable service, the average salary or your best 5 years salary with your employer, and you multiply that by a factor. So I'll give you an example. A Cadillac pension plan, so often we'll refer to the federal civil service superannuation pension plan with the federal government. That plan is 2% times your years of service, and I believe it's the best 5 career years over your employment history of pensionable service. Now, it's important that we talk about pensionable service versus years of service because sometimes when people start with an employer, there'll be a probationary period, maybe the first couple of years. So those 2 years may not qualify as pensionable years of service. So you get clear on that years of service that's pensionable, and then the benefit rates can vary. So that 2% benefit rate is the Cadillac benefit rate. And then you can see benefit rates of 1.6 or 1.5 or 1.4. And there's various factors that go into that benefit rate. It's sometimes collective bargaining. It's sometimes depending on the sector or industry you work in. You're not seeing too many 2% times years of service benefit plans around as much, but they are out there. The other little quirky thing is that sometimes you'll see pension plans with a hybrid benefit rate. So what they'll do is they'll say, well, on income above yearly maximum pensionable earnings, that's the income range where you've topped off in terms of Canada Pension Plan contributions. It's about just over $68,000 a year. Once you're above $68,000 per year of employment income, then the pension plan will give you a 2% benefit rate. Below that 68,000, they might give you a 1.4% benefit rate. So again, that's all part of the negotiation process. The employer goes, well, we don't think we need to pay you a 2% rate because on your first 68,000 plus dollars of income, your income is covered off with a portion of a Canada Pension Plan when you retire. But the bottom line is make sure you know the benefit rate. And then the other quirky thing that happens with these plans is that, again, Cadillac plans will take your best 5 years. So they'll look at your employment history and then go through and find which numbers are the best 5. Now, for many people, it might be their last 5, but not always. So a great plan will just go through your last 20 years and pick out the best 5, whereas some plans will just say it's your last 5. And then some plans will actually use your career average earnings. So if you've been there for 25 years, they'll take the average of all 25 years and use that as a number for the formula. Okay, so the devil's in the detail. Make sure that you understand those 3 really important factors. I'm finding now more and more that employers are doing a better job of having online calculators that people can plug the numbers in and take a look at. And then sometimes when you start talking to your benefits department, they'll say, those 2 years that didn't count as pensionable service, we're going to let you buy back those years of service. So that's another thing to take a look at. Does your employer allow you to buy back that, let's say, 2-year probationary period? And more often than not, it makes sense to do that. And you can actually transfer money from your RSP account to the pension plan on a tax-deferred basis to buy back that extra service that will enhance your pension plan.
And we've done that calculation difference between whether or not it's a good idea to buy back those years for many people. So
yeah, exactly.
It's really good. It's really good to compare those. All right. Number 2, this is a big one. Cost of living adjustment. Now, obviously, some pensions have the COLA, some don't. What do people need to know about this?
Well, the main thing they need to know is that for most pension plans, it's either non-existent or it's not contractual. Let me just explain what I mean. So again, we'll use the federal government's superannuation plan for federal civil servants. They probably have what I would refer to as a Cadillac cost of living benefit rate. So if the consumer price index goes up at 3% this year, then theoretically the pension plan benefits will go up at 3%. And so a lot of federal employees just kind of assume that that's kind of a contractual thing and it's going to happen forever and a day. That's actually not correct. If you actually looked at their agreements, that pension plan does reserve the right to only index at basically 2/3 of the CPI. So if the federal superannuation plan for enhanced benefits for inflation protection is not strong enough, they reserve the right not to fully index that pension plan. But I find a lot of federal employees think it's just, indexing forever and a day, and that's not the case. But for the most part, they can count on that. There's a lot of pension plans that have ad hoc cost of living increases. So what they say is, if we have enough surplus in the pension plan, we will enhance your benefit. Again, that's not something you really want to count on. If it happens, great. But when we work with clients, if it's ad hoc indexing, if we use a 3% inflation rate in the retirement income planning model, we're probably not going to use much more than 1% indexing rate. So that client's going to experience a gap. Yes, he'll get some increases, but not a lot. And then the vast majority of people will not have any indexing at all. So whatever your monthly income is when you retire in a defined benefit plan, that's what you're going to get. And so you have to cope with the impact of inflation in a different way, right? That's where having personal RSPs or TFSA accounts or non-registered investments available to use during retirement years becomes critical, because the purchasing power of that defined benefit pension plan will get degraded and eroded over time in an inflationary environment.
All right. Another great question, and we get this question from clients all the time when they have to make these decisions, but pension election options. An obvious example is spousal benefits. What do people retiring need to consider when making these decisions?
Yeah, this is a really important one. I would say that in probably all jurisdictions in Canada, if you have a partner, there is a requirement that there be some spousal benefits. If you look at most provincial jurisdictions, when you retire with a defined benefit pension plan, as an example, and you get that monthly income, you have to make sure that that income is protected for the survivor. That basic rule of thumb in most jurisdictions is 2/3, right? So if you're getting a pension upon your death, your spouse or partner will get 2/3 of that pension. Now, that's an automatic, and the only way that that's going to change is if your spouse waives their right for that. You're going to see obviously different benefit rates. You could have 100%, you could have 3/4, you can have 2/3, you could have 50%. And again, when we work with clients, one of the scenarios we always want to take a look at is, I call it the first to die scenario. So if somebody retires and then they pass away, let's say in the first 2 to 3 years of retirement, will there be enough ongoing income and financial assets to look after the surviving partner? And that analysis should be done before you retire, because that'll give you guidance on should you attach, different levels of survivor benefits on that pension. So most people, if the benefit rate between 2/3 to the survivor and 100% to the survivor isn't a lot different, they might just go with the 100%. What you find though often is that often it's the male, they're retiring. The spouse, if it's female, will often have longer life expectancy actuarially. So what happens is, in that scenario, there's going to be basically a cost. When you take a 100% to survivor benefit to my spouse or partner, then the cost of doing that is increased, because the pension plan goes, well, if you die prematurely, the female, we have to pay for an extended period of time. So what happens is, every time you put a guarantee on a pension plan, for benefits is a good example, you're going to drop that monthly income. So the highest form of pension when you retire would be a single life annuity, no guarantees, no survivorship benefits. And as you begin to layer in survivor benefits, let's say it's 2/3, which is usually the statutory requirement in most jurisdictions, it's going to drop that income. If you go to 100% to the survivor, it's going to drop it even more, right? So this ends up being an important part of planning before we retire. We sometimes see situations where there's enough of a gap in the age between the person retiring and their partner, where the partner is quite a bit younger, that there's a pretty significant gap in reduction in monthly income when they retire, because they're ensuring a survivor benefit on that pension plan. And sometimes in those scenarios, it actually makes sense for someone to actually self-insure, to buy life insurance, personal life insurance, that would be paid out to their partner upon their death, instead of putting on a survivorship benefit on the pension plan. Now, that doesn't always work. The numbers don't always work for everyone. Plus, the person has to be insurable. But we certainly have seen situations where it made sense for the spouse to waive their rights to a survivor benefit in lieu of getting a lump sum tax-free death benefit through life insurance. So that can often be a great, elegant solution. And that solution also ties into one of the issues of some pension plans. So if you can imagine, again, I'm retiring. I'm going to make sure that my spouse has a survivor benefit. And so when I do that, my monthly income is going to go down because, again, when I have those additional benefits on that pension plan, it reduces the monthly income. But what happens if my spouse predeceases me? Now, all of a sudden, I've locked myself into a long-term income that I can't change. And so I've reduced my income for the rest of my life to cover a scenario that is now not going to happen. And that's where you get into other election options. So sometimes you'll see pension plans go, okay, here's the option. You can have a lifetime income. That's a two-thirds survivorship benefit to your partner. And here's how the income is going to be paid out to you. And here's a dollar amount. And the other option is we'll do a first to die option. So rather than just being tied to your life, Shaun, we'll pay you a monthly income, and whoever dies first, the income will drop and then we'll continue to the survivor. So in that situation, I've worked hard for my pension plan. And if I live a long life, what happens is if my partner predeceases me, I'm still alive, my income will drop, right? As opposed to a scenario where in a traditional pension plan, I'm getting my monthly income. If my partner predeceases, it doesn't change that monthly income. In some situations, the pricing difference actually can make sense where the person goes, I'm prepared to walk away from a pension plan just based on my life and have it based on two lives in terms of that monthly income. The bottom line is it can get quite nuanced in terms of which of these benefit options are right for you. And it's really important before you make the election options for survivor benefits or spousal benefits that you do analysis and see how much of a survivor benefit you need. One last comment. We sometimes have folks that they've done a really good job of building up money in their TFSAs, real estate, their non-registered portfolios, their RSP RIF portfolios, and quite frankly, the spouse doesn't need in the way of a survivorship benefit. The spouse is not going to waive their right to that survivorship benefit unless they know that the overall financial plan can sustain their lifestyle. And so really what you need to do is make these election option decisions in the context of your overall financial plan. You should not just look at the pension plan and say, oh, here are my options. I'll pick this one. That's never a good idea. It
The
should
biggest
be,
number.
yeah, exactly. It should always be, oh, here's my overall plan. Here are our overall financial objectives. Here's our tax situation. Here's our estate planning considerations. And then in that context, which pension option makes most sense as we're trying to achieve our financial goals and making sure that the surviving partner's income security is looked after.
Yeah, listening to this, I think it just reiterates why planning is so important. All right. Number 4, ensuring liquidity beyond your fixed pension income. You've kind of split this into a couple different points. What do you mean by the extra bucket of money?
You know, Joshua, it gets back to some of the things we talked about in other videos, right? Is that this idea of dynamic spend when we retire. And that's a practical reality, whether we like it or not, right? So, most of us understand if we worked for a living, got a T4, and we get our biweekly income and we budget around that. Okay, that's many people's experiences. There are some occupational groups, it could be real estate agents and self-employed professionals and business owners where their income may be more nonlinear. But for a lot of T4 employees, that's kind of their world. And the reality is that I can have a great defined benefit pension plan that's going to give me income security. And let's say has cost of living adjustments to it. That's all fantastic. But the problem comes up as a result of the fact that life throws curveballs at us, right? We're going to have situations where there's healthcare expenses. There's going to be surprise expenses in terms of replacing vehicles or maybe home renovation costs that we weren't anticipating. And so it's really important that we don't become smug or overconfident around the fact that we've got this defined benefit pension plan, because that defined benefit pension plan is not going to do a great job of dealing with these other liquidity needs, these non-linear, very dynamic sort of expend rates. And that's why it's important. You may not need as much savings when you retire if you have a defined benefit pension plan as other folks that don't have them, but you still need some financial reserves to deal with those surprise expenses that can come up. So that extra bucket of money is absolutely critical. It's very important for those people that have defined benefit plans where there's no cost of living indexing. So they'll need those savings to supplement that cash flow over time. And it's important for all annuitants of defined benefit pension plans to help them deal with these surprise expenses.
So Shaun, this relates to integration and holistic planning, but we have a lot of clients asking about pension integration. What do they mean by that? And maybe expand that a little bit.
Yeah, so actually a very common question. A lot of pension plans will allow you to have more upfront income from age 60 to 65 or 55 to 65. And what they propose is, listen, we know you're going to get your Canada pension plan down the road and your old age security benefits. So what we're going to do is we're going to enhance your pension until you get those government benefits. We're going to give you a little bit more now, but what we're going to do is we're going to pull back income on your pension when those government benefits kick in. So it's a very common option that people can elect for. And the bottom line is, in almost every single situation that I see, does not make sense for most people, right? So when you start running the numbers, the extra money you get, let's say between 55 and 65 or 60 and 65, is actually way less than the income that you give up because the pension will drop, right? So rather than getting my $2,000 a month for the rest of my life, right? I decided to take integration and they're going to give me $2,500 per month for the next 5 years. And then they're going to give me, let's say, a month from 65 on, right? So the integration gives you more, but then takes money back. We give it and we take it. And almost never does it make sense to take integration. The only scenarios where we see where integration can make sense usually is if you retire and you have no financial assets, right? So you haven't been saving money, you just have the pension plan, you're going to have your government benefits, and you're just saying, listen, I want a little more upfront cash when I'm younger and I've got more energy, I want to be doing more things. I don't want to wait for those government benefits to kick in and I'm retiring before age 65. Well, then there could be an argument for integration, but for most people, it does not make sense. So, it doesn't mean you shouldn't consider it and run the numbers, but our experience is the numbers almost never work out for most people.
Could it make sense if you had a shortened life expectancy where you kind of get more money up front?
Yep, totally.
Okay.
So if you have health issues, that kind of thing, it potentially could make sense for sure.
Awesome. All right. If you're watching this and the planning side of things is not your strong suit and you want someone to check over your plan or maybe give you a plan, make sure to go to the description down below and schedule a 30-minute call with Shaun. He'd be more than happy to connect with you and talk about your retirement plan. That's all for this video. Take care.